A perfect exit in trading is never the result of luck, hope, or clever prediction. It is born from a mindset that understands the true nature of the market, uncertainty, fluidity, and the ever-present possibility that anything can happen. Most traders obsess over entries, searching endlessly for the perfect signal, the magic pattern, or the flawless setup. But the real battleground of consistency doesn't lie in how you get into a trade. It lies in how and when you get out. Exits expose your beliefs, your emotional discipline, and your relationship with risk in a way entries never will. An exit forces you to confront the unknown and act decisively even when every part of you wants to hesitate, bargain, or delay. The difference between traders who consistently grow and those who constantly struggle is simple. Consistent traders have learned to neutralize the emotional weight attached to exiting a position. They don't freeze when price moves against them. They don't panic when price moves in their favor. And they don't fantasize about squeezing every pip from the market. Instead, they operate with a structured approach built on predefined rules that protect their capital and expand their confidence. A perfect exit isn't perfect because it captures the top or bottom. It's perfect because it reflects disciplined execution aligned with a well-thought-out plan. The market doesn't reward the trader who is right. It rewards the trader who behaves correctly under pressure. Exiting a trade is the highest pressure moment a trader experiences. That is when fear of loss, fear of missing out, fear of leaving money behind, and fear of being wrong all collide at once. These are the moments when internal conflict becomes louder than market noise. Many traders sabotage themselves at the exit, not because they lack technical skill, but because they lack psychological readiness. A successful exit requires you to remove all emotional attachment from the outcome and focus only on what you can control, your actions, your risk, your rules. A perfect exit also requires acceptance. Acceptance that you will not catch every move, acceptance that some exits will feel premature, and acceptance that sometimes the market will surprise you. Acceptance creates mental freedom, and mental freedom creates consistency. When you understand that the market owes you nothing, you stop demanding certainty from it. You stop fighting price, and you begin to flow with its rhythm rather than reacting to it. This introduction is not about teaching you a technique. It's about preparing your mind for what a perfect exit truly represents. It is a psychological commitment to detach, to observe objectively, and to follow your plan even when your emotions scream otherwise. When you master the art of exiting, you master the art of protecting your trading identity. And once you achieve that, the journey toward consistency becomes not only possible, but inevitable. The moment a trader decides to exit a position is the moment their psychological discipline is exposed with absolute clarity. Entries can be planned, rehearsed, and executed with calm confidence because the emotional weight at the beginning of a trade is minimal. You haven't risked anything yet. The future is still full of possibilities and hope is at its strongest. But once the trade is live, and especially when it approaches the point where you must close it, that calm dissolves. The market begins to tug at your expectations, your fears, your need to be right, and your desire to avoid loss. You're no longer dealing with theoretical psychology. You're dealing with the raw, unfiltered version of yourself, your habits, your impulses, and the emotional patterns you may not have even known were there. This is why exits are a psychological mirror. They show you exactly who you are under pressure. When traders talk about discipline, they often think of discipline as simply following rules. But the real essence of discipline is the ability to remain emotionally neutral in the presence of pressure and uncertainty. Exiting a trade tests this neutrality to the extreme. If price moves against you, the mind begins to negotiate. Maybe it will reverse. Maybe it's just a pullback. Maybe you can wait a little longer. In those moments, you're not responding to the market. You're responding to discomfort. Your exit decision becomes an emotional escape rather than a rational act. When this happens, discipline collapses. You're no longer trading your plan. You're trading your fears. On the opposite side, when price moves in your favor, discipline is challenged in a different way. Greed rises subtly. You start imagining how much more the trade could give you. You question whether your target is too conservative. You think about how this trade could become the one that finally makes up for past losses. This mental shift transforms a profitable exit into a psychological battle. You hesitate, hoping to squeeze more out of the market. You move your stop impulsively. You convince yourself you're being patient, but in reality, you're being driven by the fear of missing out on further gains. A trader who lacks discipline in profitable exits will often give back large chunks of unrealized profits simply because they couldn't detach from the emotional temptation of more. In both winning and losing situations, exits require absolute honesty with yourself. You cannot fake discipline at the exit. You either execute the rule you planned ahead of time or you bend it under emotional pressure. Many traders don't realize that their exit behavior reveals their internal conflicts far more accurately than their entries ever could. A trader may appear calm when entering a trade, but that calmness evaporates when they are forced to make a decision in real time while money is on the line. The exit decision exposes whether you trust your system, whether you trust yourself, and whether you have truly accepted the inherent uncertainty of the market. This is why exits are the ultimate test of belief. If you don't genuinely believe in your trading plan, you will always abandon it at the exit. Belief is not something you express in words or write in a trading journal. Belief is something revealed in behavior. When you exit early out of fear, it means you don't trust your stop loss or your strategy. When you hold too long out of greed, it means you don't trust your target or your rules. When you widen stops impulsively, it means you value avoiding emotional discomfort more than you value consistency. Every deviation exposes a belief system that is misaligned with successful trading. Psychological discipline also appears in the ability to remain process-focused instead of outcome-focused. Most struggling traders exit based on how they feel about what the market might do next. Disciplined traders exit based on what they committed to do before the trade began. This difference seems small but is profound. The disciplined trader has accepted uncertainty and therefore no longer treats outcomes as personal judgments. A losing exit doesn't damage their self-worth. A winning exit doesn't inflate their ego. They simply execute the plan, knowing that edge is realized over a series of trades, not in a single moment. Meanwhile, the undisciplined trader sees every exit as a statement about their intelligence, their identity, and their worthiness. This emotional attachment turns each exit into a psychological burden too heavy to carry with consistency. Another indicator of psychological discipline at the exit is the ability to separate what the market is doing from what you want it to do. Many traders cling to hope when trades go against them. They convince themselves that the market will eventually turn their way because they need it to. Hope becomes the substitute for discipline. But the market doesn't respond to personal need. It responds to supply, demand, and collective behavior. When a trader exits based on hope, fear, or ego, they expose their inability to accept the reality of what the chart is showing. Discipline requires surrender. Surrender to the fact that the market will do whatever it wants, and your job is simply to respond according to your rules, not your emotional preferences. Exits also reveal how much control you believe you have over the market. Traders who think they can influence or predict outcomes often struggle to exit correctly because they're waiting for the market to validate their expectations. They need confirmation that they were right. But disciplined traders don't seek validation, they seek alignment with their process. They understand that control doesn't come from predicting the market, it comes from controlling themselves. The decision to exit becomes peaceful, even in loss, because they understand that success is built on consistency, not perfection. Finally, your behavior at the exit shows whether you are trading to win or trading not to lose. Traders who fear losing money often exit too early, depriving themselves of profitable opportunities. Traders who fear being wrong often refuse to exit losing trades, allowing small losses to become large ones. In both cases, the exit decision is driven by avoidance rather than acceptance. True psychological discipline is reflected when you execute exits effortlessly because you no longer view loss as a threat, profit as a lure, or the market as something to fight against. A perfect exit being rule-based rather than emotionally driven is one of the most important distinctions that separate a consistent trader from a reactive one. Most traders believe they have rules, but what they actually have are preferences. Preferences that shift depending on how the market moves and how they feel in the moment. True rules are constant. They exist independently of mood, fear, greed, and temporary impulses. They provide structure in an environment where structure doesn't naturally exist. A rule-based exit removes the need to negotiate with yourself when the market pressures you. Without rules, every exit becomes a fresh emotional decision, and emotional decisions rarely align with consistency. When a trader operates emotionally at the exit, they tend to fall into predictable patterns, holding losers too long, cutting winners too early, widening stops impulsively, or abandoning targets because of fear of missing out. These patterns come from instinct, not logic. Instinct in trading is shaped by survival mechanisms, not by probabilities or edge. The brain evolved to avoid pain and seek comfort, and the market constantly triggers both. An emotional trader exits not because the system indicates it's time, but because their discomfort becomes unbearable. A rule-based exit is designed to override these instincts by establishing predefined actions that don't require emotional processing. A perfect exit is rule-based because the rules are written before money is on the line, before emotions distort perception. Rules created during analysis are rational. Actions taken during live trading are often impulsive. Emotions narrow focus, distort risk assessment, amplify threats, and cause selective perception. When a trader attempts to exit based on what feels right, they're essentially letting a heightened emotional state dictate important decisions. This is how consistency breaks. Rules bridge the gap between analysis and execution, allowing you to act with the clarity you had before entering the trade. Having rule-based exits also reinforces trust in your trading plan. Many traders think they lack discipline, but what they truly lack is trust. They don't fully believe their system will protect them or provide long-term profitability. Because of this, when the moment to exit appears, they override their rules. A rule-based exit doesn't just enforce structure, it builds confidence in your own ability to follow through. Every time you obey your exit rule, you strengthen the psychological foundation required for consistent execution. Over time, this becomes self-reinforcing. Because you followed your rule, you trust it more. Because you trust it more, you follow it more easily. A rule-based exit also creates emotional stability. When you know exactly what you will do at every possible point, there is no room for internal conflict. Conflict is what causes hesitation. Hesitation is what leads to late exits, early exits, or poorly managed exits. A clear rule eliminates conflict by removing the need to evaluate the situation in real time. Instead of analyzing the market while under pressure, you simply perform the action you predetermine. This reduces stress and increases the likelihood of maintaining objectivity. Without rules, the exit moment becomes a battlefield between fear and desire, logic and impulse, analysis and instinct. The market thrives on uncertainty, and uncertainty fuels emotional volatility. A rule-based exit cuts through that uncertainty by giving you something unchanging to rely on. The rule becomes your anchor. Whether the market spikes, dips, consolidates, or becomes unpredictable, your exit parameters remain the same. This stability allows you to operate with a calm mind. A trader without exit rules is constantly improvising. Improvisation in trading is dangerous because it pulls you into a cycle of emotional reasoning. Maybe it's not the right time. Maybe it will turn around. Maybe I should wait a little longer. A rule-based exit removes the maybe and replaces it with this is what the plan requires. A perfect exit doesn't aim for perfection in capturing every pip or catching the exact top or bottom. It aims for consistency, repeatability, and alignment with a long-term edge. These qualities can only come from rules. Emotion may lead you to exit correctly once or twice by coincidence, but coincidence cannot be duplicated on demand. Rules can. When your exit is rule-based, every trade becomes part of a larger statistical sequence. Wins, losses, and break-evens work together to express your edge over time. Emotional exits disrupt the sequence because they introduce randomness. Randomness destroys edge. Rules preserve it. Rule-based exits also clarify risk. When you know exactly where and how you will exit, you know exactly how much you are risking. Emotional exits distort risk. Because they shift unpredictably, you might cut early out of fear or let a loss run because you're afraid to accept defeat. This inconsistency leads to unbalanced risk-to-reward ratios, which erodes account performance. A rule-based exit locks in risk parameters and keeps them stable across trades. The trader gains a clearer understanding of exposure and reduces the possibility of catastrophic losses caused by emotional decision-making. Another important aspect of rule-based exits is that they align your actions with market structure rather than personal bias. Emotional exits depend on perception of danger or opportunity. Rule-based exits depend on objective criteria such as stops, targets, volatility shifts, or trailing mechanisms. This alignment with structure removes the need to interpret the market during stressful moments. Interpretation is subjective. Rules create objectivity. Objective exits protect traders from the biases that arise when interpreting charts under pressure. Biases such as anchoring, hindsight thinking, confirmation bias, or loss aversion Rule-based exits also simplify the decision process. When you reduce complexity, you reduce the opportunity for psychological errors. Emotional exits create complexity because the mind tries to assess multiple conflicting variables simultaneously: what the market is doing, what it might do, how much profit is at stake, how much fear is present, and how much uncertainty remains. This cognitive overload weakens decision-making. A rule-based exit cuts through the noise by giving you one clear instruction. Simplicity strengthens execution, and execution is what produces consistent results. Most importantly, a perfect exit becomes rule-based when a trader fully accepts that they cannot control the outcome of a trade. They can only control their behavior. Rules reflect that acceptance. Emotional exits reflect resistance to that acceptance. A rule-based exit acknowledges uncertainty instead of fighting it. It respects the reality of the market instead of trying to bend it. It creates a framework within which a trader can operate calmly, confidently, and consistently despite the unpredictability that surrounds them. Acceptance of uncertainty being essential for consistent exits is one of the core psychological principles that determine whether a trader develops long-term stability or remains trapped in cycles of frustration, fear, and inconsistency. The moment you place a trade, you enter a world where you no longer have control over what will happen next. You can analyze, plan, anticipate, and prepare, but once the position is live, the market takes over completely. For many traders, this loss of control creates tension. They try to regain it through prediction, hope, denial, or emotional manipulation of their own decisions. But trading is not an arena where control comes from predicting outcomes. It is an arena where control comes from accepting that outcomes are inherently uncertain. This acceptance is what allows a trader to exit correctly. Most traders struggle with exits precisely because they resist uncertainty. They want to know what will happen next, and because they can't, they hesitate. They question themselves. They second-guess their rules. They wait for more confirmation. They look for signs that justify staying in a trade or getting out of it. Every extra moment spent seeking certainty increases emotional pressure, and under pressure, emotional reasoning takes over logical reasoning. Exits then become distorted by fear of loss, fear of missing out, fear of being wrong, or fear of regret. When a trader accepts uncertainty, these emotional reactions diminish significantly because the trader no longer demands something from the market that the market cannot give. Acceptance creates mental freedom. When you fully accept that you cannot know how far a winning trade will go or when exactly a losing trade will stop, you stop fighting reality. You stop resisting the fact that anything can happen. This mental shift is critical. Most exit mistakes are rooted in resistance. A trader resists taking a small loss because they hope the market will rescue them. They resist taking a profit because they believe more is coming. They resist following their stop loss because they can't accept being wrong. Acceptance dissolves resistance by removing the unrealistic expectation that the market should behave in a way that aligns with personal desires. When you accept uncertainty, you allow your exit rules to guide you because you're no longer chasing perfect outcomes. You stop trying to engineer a flawless result from an inherently unpredictable environment. Instead, you focus on what you can control, the consistency of your behavior. This shift transforms the meaning of an exit. It is no longer a moment of pressure where you must somehow guess the right timing. It becomes a simple execution of a predefined decision, made with the understanding that long-term consistency matters more than short-term outcomes. Acceptance of uncertainty also changes how you perceive losses. Many traders take losses personally because they interpret them as failure, incompetence, or proof that their analysis was flawed. This emotional interpretation fuels avoidance. They avoid exiting losers because they don't want to face the emotional discomfort that comes with admitting the trade didn't work. They widen stops, hold through deeper drawdowns, or rationalize reasons to stay in, but losses are a natural part of trading. They are not avoidable, and they are not punishments. When a trader accepts that uncertainty makes losses inevitable, the fear attached to them diminishes. Exits become cleaner, more consistent, and less emotionally charged. Acceptance also affects how traders treat winning trades. A trader who doesn't accept uncertainty often feels fear even when a trade is moving in their favor. They worry that profits will evaporate. They exit too early because they're trying to secure something before uncertainty takes it away. They treat every small fluctuation as a threat. Acceptance calms this fear. When you understand that you cannot control how far a move will continue, you no longer try to protect yourself from every tick against you. You follow your rules because you know the rules are designed to handle uncertainty better than your emotions can. Another important dimension of acceptance in exits is understanding that no exit method will capture the best part of every move. The desire to maximize every trade is rooted in a refusal to accept randomness. Traders often think perfection is possible if they just get better, but perfect timing is a myth created by hindsight. Once you accept that some exits will feel early and some will feel late, you free yourself from the emotional burden of trying to master the impossible. You begin to focus on consistency rather than perfection, and consistency is the only path that builds long-term results. Acceptance also strengthens objectivity. When you are no longer emotionally attached to a specific outcome, you see the market more clearly. You notice signals without filtering them through fear or hope. You follow your plan without trying to force the market into your expectations. Objectivity during exits is extremely difficult when uncertainty is not accepted. The trader's mind tries to create certainty where none exists, and this mental fabrication distorts decision-making. Acceptance dissolves the need for artificial certainty and keeps perception grounded in reality. When you fully accept uncertainty, you also stop trying to be right. Traders who cling to the need to be right sabotage exits because closing a trade, especially a losing one, feels like admitting defeat. They delay exits to protect their ego rather than their capital. Acceptance removes ego from the equation. You no longer see being wrong as threatening because being wrong is an unavoidable part of the probabilistic nature of trading. This allows you to exit losing trades quickly and efficiently without emotional conflict. Finally, acceptance of uncertainty creates emotional stability. The greatest psychological stress in trading comes from trying to control the uncontrollable. When you stop trying to predict, force, or manipulate outcomes through emotional behavior, your mind becomes calmer. A calm mind exits trades correctly. A calm mind follows rules. A calm mind understands that consistency comes not from knowing what will happen next, but from being prepared for whatever happens next. Exits matter more than entries for long-term profitability because the outcome of every trade is defined not by where you start, but by how you finish. Most traders devote the majority of their time to searching for the perfect entry, convinced that the right signal or pattern will unlock consistent profits. But consistency has nothing to do with finding perfect entries. Market conditions change, setups evolve, volatility shifts, and the signals that once worked beautifully eventually lose their effectiveness. Entries are unstable because they rely on identifying opportunities in a constantly changing environment. Exits, on the other hand, are rooted in managing risk and locking in reward, and these principles remain constant regardless of how the market behaves. The quality of your exit determines whether your edge is expressed properly, whether your risk stays controlled, and whether your account grows over time. An entry only opens the door to potential. The exit decides whether that potential is realized or wasted. Many traders enter good trades but fail to exit them correctly. As a result, winning trades turn into break-evens or losses, and losing trades turn into devastating drawdowns. A trader can survive dozens of imperfect entries if their exits are disciplined, but even the best entry in the world cannot save a trader who exits poorly. This imbalance is why exits weigh more heavily on long-term results. The outcome of a trade is always determined at the exit point, not the entry. Profit or loss is crystallized only when you close the position. Until then, everything is theoretical. The trader who masters exits masters the point where money is truly made or lost. Exits matter more because they directly control risk. Entries can be exciting, anticipation, possibility, new opportunity, but exits require a confrontation with reality. A losing trade forces you to face the fact that the market is moving against you. Without a proper exit strategy, that confrontation becomes emotional. Traders hold losers hoping they will turn around, widening stops and ignoring signals. What starts as a manageable loss can become catastrophic simply because the trader refuses to exit. A strong exit rule prevents small losses from becoming disasters. It allows the trader to protect capital even when the market behaves unpredictably. Risk management lives entirely at the exit, not the entry. You can enter small or large, early or late, aggressively or conservatively, but without disciplined exits, you cannot prevent significant damage to your account. Exits also determine the consistency of your reward. Most traders cut winners too early because they feel anxious watching open profits fluctuate. They exit impulsively at the first sign of retracement. This prevents their profitable trades from reaching their full potential. The few trades that could have provided exceptional returns are cut short, and the trader ends up relying on many small wins that cannot compensate for occasional large losses. A disciplined exit strategy ensures that winners grow large enough to offset inevitable losing trades. It ensures that the positive skew of an edge can express itself over time. Entries cannot guarantee profitability. Because profitability requires asymmetry, your average win must exceed your average loss. That asymmetry is created by exits, not entries. Another reason exits matter more is that they reveal the trader's psychological relationship with the market. Entries are generally made from a place of confidence. You see what you want to see, you feel prepared, you believe the trade has potential. Exits are made from a place of uncertainty. You have to make decisions while money is at stake. This exposes emotional tendencies that influence behavior, fear, hesitation, greed, denial, and impatience. These tendencies ruin performance far more than picking the wrong entry ever will. You can choose an average entry and still profit if your exit is well controlled. But even the most precise entry becomes irrelevant if you exit based on emotion. Long-term profitability requires emotional neutrality during exits, and this neutrality can only be cultivated through clear rules that guide behavior under pressure. Exits matter more because they shape your risk-to-reward structure across a series of trades. Profitability is statistical. 1 trade means nothing. 10 trades mean little. 100 trades reveal your true edge. Across large sample sizes, entries tend to average out because markets move unpredictably. Sometimes an early entry works perfectly, sometimes it gets tested, sometimes a late entry catches the move anyway. But exits determine the final distribution of outcomes. If your exit rules produce small losses and allow occasional large wins, your equity curve grows. If your exit rules produce large losses and small wins, your equity curve declines. The market does not reward accuracy, it rewards structural advantage. Structural advantage is built at the exit. Exits also provide the trader with psychological stability. When your exit strategy is unclear or based on emotion, every trade becomes a source of anxiety. You are constantly questioning when to get out, whether to wait longer, whether to tighten stops, or whether to take profits early. This internal conflict drains mental energy and leads to inconsistent behavior. Trader without clear exit rules experiences trading as emotional chaos. A trader with clear exit rules experiences trading as a sequence of planned actions. Emotional chaos creates inconsistent results. Planned actions create predictable, stable performance. Entries rarely cause chaos because there is no pressure yet. Exits carry all the pressure. Stability comes from mastering exits. Exits matter more because they determine how you respond to changing market conditions. The market can shift from trending to consolidating, from volatile to quiet, from directional to erratic. Entries that worked yesterday may fail today, but exit rules adapt naturally because they are based on your risk tolerance and behind-the-scenes market behavior, not pattern recognition. A good exit system can perform consistently in different environments because it is designed around protecting capital and managing reward. It does not need the market to behave perfectly to be effective. This adaptability is what keeps traders profitable long-term, even when their entries evolve or lose effectiveness over time. Finally, exits matter more because they shape trader identity. A trader who masters entries but not exits becomes impulsive, reactive, hopeful, and undisciplined. Their confidence fluctuates with every trade. A trader who masters exits becomes calm, consistent, structured, and objective. They stop trying to predict the market and start responding to it. They stop trying to be perfect and start trying to be consistent. They stop trading based on emotion and start trading based on rules. The identity of a profitable trader is built not through great entries, but through disciplined exits. Detachment from outcomes strengthens execution because it frees the trader from the emotional weight that distorts decision-making at the most critical moments. Trading becomes exponentially harder when every trade feels personal, when every pip fluctuation feels like a judgment, and when every result is interpreted as a reflection of your worth, intelligence, or capability. The market does not speak to you personally. It does not reward deserving traders or punish careless ones. It simply moves based on collective behavior. When a trader attaches personal meaning to outcomes, they shift from being an observer to being emotionally entangled, and emotional entanglement is the greatest enemy of consistent execution. Detachment is what allows a trader to act according to their plan rather than reacting to internal pressure. Detachment is not indifference. It does not mean you don't care about your success. It means you care about the right things, following your rules, protecting your capital, executing your strategy, and maintaining your psychological balance. When you detach from the outcome of any single trade, you stop trying to force the market to deliver the result you want. You no longer judge yourself based on the immediate profit or loss. Instead, you see each trade as one event in a much larger series where the only thing that matters is whether you executed correctly. This mindset shift takes emotional intensity away from exits. Without emotional intensity, clarity becomes possible. Detachment strengthens execution because it removes the fear that arises when you feel you must win. When a trader feels they need a trade to work, they become rigid. They avoid proper stops because they refuse to accept a loss. They take premature profits because they cannot tolerate the possibility of losing what they already gained. They break rules in an attempt to protect themselves from emotional discomfort. The root of all of this is attachment. When you detach, you no longer require a specific trade to justify your identity. You no longer interpret losing trades as personal failure. This freedom dramatically increases your ability to execute exits exactly as planned. Fear-based exits disappear when detachment takes hold. Fear is a signal that the trader is focused on the result rather than the process. Fear makes traders exit too early, hesitate to exit when necessary, or avoid exiting altogether. But when you detach, fear loses its leverage. The outcome of the trade is not a threat, it becomes simply data. You take the exit because your rules say it's time. You don't bargain with the market. You don't bargain with yourself. You acknowledge the uncertainty and act in alignment with your plan. This is why detachment is essential for consistent rule-based decision making. Detachment also eliminates greed from the exit process. Greed is the emotional desire for more than what the market is offering at that moment. A trader attached to a specific outcome sees profit as something fragile that must be captured immediately or maximized completely. They attempt to squeeze every point, believing that bigger wins will compensate for past mistakes or accelerate progress. But this mindset distorts execution. It leads to abandoning targets, ignoring signals, and allowing profitable trades to reverse entirely. When you detach, profit is not something to protect through impulsive action or something to chase through hope. It is simply the natural result of following your plan. You let winners reach their targets or follow the trailing mechanism because you are no longer emotionally tied to the desire for more. Detachment improves observation. When you are attached to outcome, your perception becomes biased. You interpret market behavior through the lens of what you want to happen. You ignore warning signs because they conflict with your desires. You overemphasize signals that confirm your expectations. This distorted perception leads to poor exits. A detached trader, on the other hand, sees the market objectively. They are not filtering information through emotion. They can execute their exit rules without internal resistance because they are not hoping for something different than what the market is showing. This objectivity enhances timing, clarity, and decision quality. Detachment strengthens confidence because confidence rooted in outcomes is fragile. A few losses can destroy it. A few wins can inflate it. This roller coaster creates unstable execution, but confidence rooted in process is unshakable. When you detach from outcome, you measure success by how well you followed your plan. Even a losing trade can strengthen your confidence if you executed it properly. This creates the emotional stability needed to exit trades consistently. Instead of being shaken by losses, you understand that losses are simply part of the probabilistic structure of trading. Instead of becoming overconfident after wins, you remain grounded because you know the outcome was not the source of your success, your discipline was. Detachment also creates patience, which is essential for proper exits. Traders attached to outcome often exit too early because they cannot tolerate the market's fluctuations. They see every pullback as a threat. They see every sideways move as danger. They treat every minute in the trade as emotionally costly. Detachment removes this urgency. You don't feel anxious waiting for your stop or your target to be hit because you no longer fear what will happen. You've accepted uncertainty. You've accepted imperfection. You've accepted that the outcome does not define you. This patience allows winning trades to unfold naturally and losing trades to be cut quickly when necessary. Detachment fosters consistency across a large number of trades. When you are attached to outcomes, your behavior varies depending on whether you are winning or losing, confident or uncertain, calm or stressed. This inconsistency destroys statistical edge. You might follow your exit rules for 5 trades, then ignore them on the 6th because an emotional spike blinds you. Over time, these impulses accumulate and sabotage results. Detachment removes emotional spikes by making each trade emotionally neutral. You treat every trade the same. Your exit behavior becomes stable and predictable. Consistency is built on emotional neutrality, and emotional neutrality is built on detachment. Detachment is also the foundation of resilience. Trading inevitably includes drawdowns, losing streaks, unexpected reversals, and periods of confusion. Traders who are attached to outcomes take these periods personally. They get discouraged. They fear placing the next trade. They become hyper-focused on avoiding losses and therefore violate their own rules. Detachment protects mental stability during these difficult phases. Because your identity is not tied to your results, you can continue following your plan even when the market is not cooperating. This resilience is what allows you to survive long enough for your edge to play out. Finally, detachment transforms you from a reactive participant to a disciplined executor. When you detach from outcome, you become committed to the process rather than the emotion of the moment. Exits become mechanical, clean, and consistent. The market no longer controls your behavior because you are no longer emotionally dependent on any outcome it produces. You act because your plan says to act. You exit because your rules say to exit. You remain steady because your identity is not tied to being right, but to being disciplined.